All right, let's go into our financial 15. So I'm going to switch to my whiteboard here. Just preparing the whiteboard here. And we're going to talk about tax loss harvesting. Okay, tax loss harvesting. So this again came about as we were doing our year-end planning here, and we're gathering information from clients. And one of the things we always look at is, do we have gains in capital gains in accounts, and can any of these be offset with losses, realized or unrealized losses? So as we go through this, I'm going to talk about some of the pros and cons, but there's some risks involved in that also. So you can say, okay, well, I've got, it's this kind of lemonade roll. I've got $60,000. I'm just using that as an example. $60,000 worth of unrealized losses in my these are not IRA accounts or Roth IRA accounts. These are taxable, what we call taxable accounts, and we call them taxable accounts because you get 1099s every year for interest, dividends, short-term gains, long-term gains, etc. So sitting in that taxable bucket, can we take losses on this and kind of make lemonade out of these lemons, and then we can use those losses either to offset immediate gains or do what we call carry forward those losses. And you can then buy the securities back. You've got to pay attention to some rules around that. We're going to talk about it, but that's the general idea behind tax loss harvesting. Well, here we go. We have these losses in these taxable accounts. Does it make sense to sell them for a period of time? Potentially buy them back after the rules say that we can, and still own them. But we've now realized this loss. We still own the security, and we can either book the loss for this year, offset gains with it, or carry them forward into following years. So let's talk some more in detail. So what is tax loss harvesting? And again, if you're just joining us for the Financial 15, what we've just talked about on the rest of the weekly webinar is some headlines. We talked about the CPI data for October that was released this morning. We talked about the increases in the income brackets for the marginal tax rates. We also talked about the downgrade of the United States by Moody's. I think it was Moody's downgraded to negative from stable. Then we went over some investment returns and analyst reports for the past week. And now we're in our Financial 15. So if you're just joining us for our Financial 15, this is when we talk about a financial planning strategy or an investment strategy in more detail. And if you're just joining us on YouTube, you can hit the subscribe, like, and notification button so that you make sure that you don't miss any of our upcoming videos. And if you'd like to receive this video via recording, you can request to be putting on our mailing list by reaching us at attleborowealth.com. I'm just going to put that up here, attleborowealth.com. And if you want to schedule time with us or with me or have any questions, you can reach us at questions@attleborowealth.com. Okay, so what is tax loss harvesting? Now, I want to point out this is from Investopedia. I'd like to share things with you that you can grab via Google. Tax loss harvesting is the timely selling of securities at a loss to offset the amount of capital gains tax owed from selling profitable assets. The strategy is commonly used to limit short-term capital gains commonly taxed at a higher rate than long-term capital gains to preserve the value of the investor's portfolio while reducing taxes. I will say that is the best use of tax loss harvesting, but it's not the only use. So I'll share with you here that here we go. This is the orange tax chart from the Slack group, and you can grab that from our website. Go to attleborowealth.com, go to resources, and drop that down a Slack corner. And you can download these charts. But we talked at the beginning of the webinar about the marginal tax rates, and when you cross over into these other tax rates, as your taxable income increases. But we're talking about capital gains rates, and these are completely different. And long-term, and by the way, long-term capital gains we're talking about here. So it can be, you can pay capital gains rate at 0, 15, or 20%. Remember, I know I did a video about this. You got to pay attention to 3.8% Medicare surcharge. But, these are the income thresholds for the capital gains rate. So they're long-term capital gains rates. Now, short-term capital gains rates, I'm back over here on the left, they get treated like ordinary income. So what the piece from the excerpt from Investopedia just said is most people use tax loss harvesting to offset short-term capital gains. And while that's probably the best use of the tax loss harvesting, a lot of people use it also to offset long-term capital gains because, your capital gains rate could come in anywhere. Say it's at 15%, and say your marginal tax rate is at 22%. Well, obviously, if you can use your realized losses to offset 22%, you're in better shape. But if you exhaust all that or don't have short-term gains to offset, there's nothing wrong with using it to offset 15%. So I hope that makes sense. We can talk about that a little bit more as we go. You have to pay attention to this wash sale rules. Of course, there are rules around these processes. You can't just buy a stock, quickly sell that stock quickly, and we're going to talk about the rules, what quickly means from the IRS. Buy it, quickly sell it, realize a loss, and quickly buy it again and own it and have this loss booked or use it for your benefit to reduce your taxes. The IRS says there's got to be some parameters around that. So the main thing to watch out for when tax loss harvesting, this is reported in U.S. News, is the IRS wash sale rule, publication 550. I think I have a link here. Yep, publication 550. So you can grab that and read that publication if you'd like. Publication 550 says that when you sell a security or substantially identical equivalent for a loss, you can't buy it back for 30 days, nor could you have bought it 30 days prior to the sale date. So if this is your sale date here, you've got a 30-day span on either side of that. So if you bought it within this window and if you sell it within this window, you don't get to have the tax loss. It goes away. And you've got to pay attention to substantially identical. There's some questions around exchange-traded funds and mutual funds and how that, particularly exchange-traded funds. It also is in effect throughout the entire portfolio. So just like the fellow, I think his name was Thomas, who had the question about, well, geez, if I convert my entire traditional IRA by the time in the year I turn 73, do I have still an RMD? The IRS is keen to most of these things. So you can't liquidate a position in a taxable account and rebuy it in your IRA inside of the wash sale rule and think that you're gaming the IRS. This wash sale rule is in effect throughout the entire portfolio, your entire ownings. And it also includes a spouse, a partner, or other entity that you have control of. So I'm not saying you have a control of your spouse or partner, but I can't, for example, I'm always reluctant to name a stock. But let's say Attleboro Wealth Management was a publicly traded company, which it's not. And we had, a significant loss in September, which we didn't. But let's just say there's a significant loss in September in this position I hold called Attleboro Wealth Management. And I say I'm going to sell this position and I'm going to realize that loss for tax purposes. But I don't want to wait 30 days to rebuy this position because I think there's risk in the issue increasing. So I say, you know what, I'm going to have my wife buy it in her account or buy it in her IRA, and then we still own it, kind of. And I get to realize this loss for tax purposes. Again, the IRS is keen on that. We don't want to, you can't do that. And that includes through an issuer's dividend reinvestment program. So a lot of these are set on automatic reinvestment. You can buy direct with different companies and different funds. So be careful about that, because suddenly if you sell something, you're trying to avoid this getting caught in this wash sale rule. You've got to know the nuances, and one of those is the issuer's dividend reinvestment program, spouse and partners accounts or other entities, and you've got to look throughout the entire portfolio. So those things, these are missed a lot. People think that they can just, again, they don't really think it through. There's a lot of information out there on the on the internet about these wash sale rules, and it seems pretty simple. Okay, I sell it, I don't repurchase it until the 31st day, but if I buy it again in another account during that time, it's a potential problem. So we've got to pay attention to those things.